Prableen Bajpai joining us from FinFix Research and Analysis to take us through all that you should be doing for your savings and investment plan as you head into a new financial year. This is something that's important for all of us, Prableen. So, timing wise, is this the right time to take a closer look? What should one be focusing on this time around? What are the essentials? And what kind of goals should one have when looking at their savings portfolio?
Hi, Aabha. Great to be here. You just talked about the timing, and I'm so happy that we're having this conversation in the first month of the financial year rather than the last month of the financial year, especially because I think it's so over concentrated with everybody looking at doing their last minute tax savings. So I think this is the perfect time. And a lot of reasons for that. This is the time of the year when individuals are getting their bonuses.
Yeah.
There is increment in salaries. Freshness is there because, of course, we went to the new financial year. So it is the time to, take a look at what is your income now, the new income that the person is getting. What are your particular, expenses which have been ongoing in the previous year, and if there is an increase in them. Do you have any new goals? So you have to go back and reevaluate your financial goals as well. Secondly, Abha, I think it is also a great time to look at your debt portfolio. If you have a home loan, if you have a car loan, go see if somebody is looking at paying up the loans during the financial year, especially high interest rate products such as credit card loans and personal loans. I think that should be one of the priorities before you actually start to restructure your investments. So looking at your all sorts of debt and loans on an individual. Another thing here is very crucial. This is also the time to check your essentials. Essentials are including your emergency corpus, your life covers, and your health plans. Usually, if an individual is getting a bonus, it is easier to set aside, a sum to sort of set up your emergency corpus if it wasn't existing. So I think from that point of view, it is a great time. Tax planning, again, this is the perfect time to relook at that. And tax planning, I think, is a very, very integral and a very important component of your overall financial planning, because a small contribution of 1,50,000 a year can actually give you in a span of 35 years, can give you a corpus of about 7 crores if you're using the right instruments. So it can actually sort of cater to a bigger goal that you have set for yourself, let's say 60% of your retirement basket, okay, or something else, which is those many years away. And finally, I feel what happens is that over a period of time, as we keep earning, our lifestyle changes and our expenses increase, and unknowingly, the expenditure basket that we have keeps on increasing, but we usually don't go and check that. And with every increment in salary, there is a little lifestyle modification. You probably are shopping more, you're traveling abroad, maybe instead of travel twice abroad, maybe it's thrice a year. So I feel that with every increment in salary, it is so crucial to set aside an incremental amount of investment as well. And that little, even 1,000 increment every year that you make, I think can really cater to that increase in your lifestyle expenses.
So how should one look at asset allocation in order to make the most of some of the concessions available? Is it primarily fund focused? If so, what kind of funds should one look at as well when thinking of building their portfolio?
So I feel, Aabha, this is personal finance is so personal, yeah. And the best way to look at is define your own financial goals. It is almost like if I need to go to the market, I should know that, okay, the market is a kilometer away. Do I want to drive down to the market or just walk down to the market? So when you know that what is your final objective, it becomes very easy to choose the right product, which can enable the individual to actually meet the objective and reach their financial goals. So for financial goals such as retirement, which usually would, which are long-term goals, I would suggest that, the equity component of your portfolio has to be higher. Of course, supplemented with good products such as the employee provident fund. But of course, we've seen a little cut in the interest rates there as well. And one is investing for something in the near term or medium term, then of course the preservation component becomes a priority. Maybe the person doesn't want to take too much of risk. So there, the combination of a debt product, a fixed income product, can be in higher proportion as compared to equities. And that's how you sort of set up your overall asset allocation. And of course, your own comfort, because your risk appetite is very, very crucial here in defining what is your comfort zone, and where do you find peace? Because if somebody is investing out of their comfort zone, I think they would make those sort of uncalled for exits, and they won't stick through the journey, especially in equities. So it's very important to have a overall asset allocation based investment chart for yourself, but considering all these factors.
So run us through what the core and satellite approach is in a portfolio for those that are not familiar with it, how it works and what the advantages are.
So because we just spoke about the risk appetite of an individual, I feel, Aabha, here what's important is that we define our overall portfolio into two baskets, which is, one is your core. Core is that basket of your portfolio wherein you're having products which match your own risk appetite. So if I'm a conservative investor, my core would be probably products like a public provident fund, employee provident fund, more of fixed income products. And then my satellite would be something which can take slightly higher risk. So for a conservative investor, their core 60 to 70 or 80% would be these, traditional fixed income sort of products. And that probably 15-20% is something where they're looking at higher returns and they can step outside their comfort zone and invest, which would be part equity or a combination of equity and debt. While it would be the other way for an investor who's aggressive, and for them, the core would be, mostly equities. And within equities, the core ideally should be simpler products. Within equities, it can be formed of index funds, exposure to large cap index funds, mid caps. I think we have so many good passive strategies now coming in India, and even exposure to outside India. Okay. And for them, their satellite would be simpler products, probably in the fixed income space.
Okay. I was in fact going to ask you about diversification, and when you're talking about investments outside India as well, there's a current capping, I think, of 7 billion to invest abroad via mutual funds. While the underlying scheme or product is not a foreign domiciled ETF. Tell us a little bit more about that, what the best route is to perhaps look for that diversification into global markets.
Absolutely, Aabha. In fact, I was just studying some data, and I'll share that data with you. So currently, in the last 2 years, I think that's when global investing has actually seen a huge rise. The number of the AUM of schemes, I'm just taking the FOF route, which is the data given by AMFI, and the AUM was only about 2,700 crores at the end of March 2020. And now it is 22,000 crores at the end of March 2022. So we've seen this phenomenal rise, and this particular segment is about 3 billion of that 7 billion basket. So we have other products within the mutual funds wherein they are, directly holding stocks in a portfolio of stocks for the investors. There are a lot of schemes. So overall, all of these have cumulatively hit this 7 billion limit. Which was set up, of course, in the year 2008. So I think 14 years, till today, I think, Aabha, of course, we are very hopeful that this limit should be increased because I think if you're just looking at the reverse, US funds investing in India, they are already investing about 8 billion. Sure. So I think this is a sign of a progressive economy where you do allow your individuals to invest abroad. But there is another bucket, which is your ETFs. ETFs not domiciled in India, but domiciled outside India. And that was a separate basket of about 1 billion. And they're only about 15% exhausted till now. And that is the segment where schemes are open for investors to invest. Majority are passive routes. And in fact, a lot of fund houses are filing for NFOs as well and have their proposals with SAVE. And a couple of schemes which are currently open for investors are like DSP Global Innovation Fund is open. Then you have the NASDAQ fund from Kotak and ABSL, Navi. Invesco has come up with one. Then you also have the Vanguard ETF, which is tracked by Navi. So these 4-5 products are currently open for investors to invest outside India, and this is all primarily in the US.
Okay. When investing, what is the kind of investment horizon one should look at? And also corpus. Would you suggest putting aside 20% of your income? Would you say it's okay to invest even the most nominal sum, let's say through an SIP route? And let's address perhaps a retail investor first, and we can always come to other segments after that. But for a regular investor, and if you could define perhaps via an income bracket, what would be a reasonable corpus to suggest investing in with, let's say, a medium to long-term horizon?
So I feel, Aabha, if we're just looking at international investing currently, then this segment can be about anywhere ranging between 5 to 20 to 25% also, depending on the goals of the investor. Okay. Because if, let's say, somebody has a kid who's just about 1 year old and they do plan to send their child abroad for further studies, so 17 years later, they would be paying the fee in dollars. So I think for them, maybe the allocation outside India can be higher, maybe even 25 to 30%. Okay. But of course, the element and the underlying nature of stock markets remains the same, whether we are investing in Indian equity markets or outside India. So that must be remembered. And, that is something which investors have to be very cautious about. That yes, it's not that if you're investing outside India, then there is no risk or there won't be volatility. That will be there. And I think this year beginning, we've seen already a lot of volatility and drawdowns, bit even in the US markets. And otherwise speaking, broadly, general investments, then I would say that a small corpus, a small sum of, let's say, 10,000 SIP over a 15-year period through mutual funds can actually create a basket for them for about 50 lakhs over a 15-year period, considering a 12% return. And I think 10,000 is a reasonable amount, which probably even young kids of today who just started working, and a lot of people can afford to invest. And this little amount, if they do this increment of, let's say, this year my monthly SIP is 10,000, and the next year onwards it's 11,000, and hence it's 12,000. That can actually create a corpus of about 96 lakhs in the same time period. So investment up to about 25 to 30% of their salary, I think, is a great thing. Loans shouldn't be too much, I feel. That has to be contained as well. Even if you're not investing, it shouldn't be that let me invest and take a home loan to buy a house to save taxes. That approach would be wrong.
All right, Prableen, thank you so much for joining us and for that comprehensive view on how to look at your savings and investments as we kickstart a new financial year. Thanks for being with us in Business Today.
Thanks so much, Aabha. Thank you.
If you like the video, do like, comment, share and subscribe.